So today we're going to learn what an FHA loan is, but we're going to learn from my daughter. So let's see what she has to say. What's an FHA loan, honey?
Let me just play Roblox.
I think it has something to do with Roblox. We're about to find out what an FHA loan is. Alright, so an FHA loan. An FHA loan is typically a mortgage that's insured by the Federal Housing Administration. Simple as that. Also known, well, as an FHA. It's designed to help first-time home buyers, low to moderate income home buyers, and also those with low credit scores be able to purchase a home. It typically offers a low down payment requirement that can be as low as 3.5%. As long as you have a credit score of a 580 or higher, as well as more flexible credit and also more flexible income guidelines. And it also even offers competitive loans as well. A borrower can still get an FHA loan with a credit score of 579 or lower, all the way down to a 500 actually. But then they also have to pay a 10% down payment. Now, the FHA insures the loan, which is reducing the lender's risk, which makes it easier for the borrower to qualify, of course. However, the FHA loan then also requires the borrowers to pay mortgage insurance premiums. We also call that MIP. Now, they pay it both upfront and also annually to protect the lender in case of a default. Now, the upfront mortgage insurance premium is a one-time payment that's usually about 1.75% of the loan amount. And again, that's 1.75% of the loan amount typically. Now, it's paid at closing, or it could be rolled into the loan. Now, the annual mortgage insurance premium is paid monthly, ranging from 0.15% to 0.75% of the loan amount annually. Now, keep in mind, it's a range because you may have like a very long loan up to 30 years, or you may have a very short loan up to like 15 years. So it all depends on the length of the loan for as to how high that monthly payment would be that you need to make. Now, the annual mortgage insurance premium is typically required for the life of the loan unless if you make a down payment of 10% or more, in which case it may be removed then after 11 years. So, you may get an offer from a lender or mortgage broker with a lower interest rate than kind of like a conventional loan, which is common today. However, when you include the upfront mortgage insurance premium and the annual mortgage insurance premium, you may find that due to these additional fees, your monthly mortgage payment may actually be higher than if you went with a conventional mortgage that has a higher interest rate. This is a primary example on the fact that getting a lower interest rate on one product doesn't necessarily mean that you're paying less throughout the life of the loan. So, let's take a moment here and take a deeper look into an example of an FHA loan by going into some of the discussed mechanics of it. Now, we're going to use an example of the home value at around $500,000 and that the person that wants to get the loan has a credit score of at least a 580 or above. Now, in having a credit score of 580 or above, they should be receiving a 3.5% down payment. Now, a 3.5% down payment off of a $500,000 would be $17,500. And we do that simply by taking 500,000, multiplying that by 0.035, and that gives you 17,500. Now, on top of that, we also have then of 482,500. We simply got that by subtracting the 500,000 from the 17,500 then of your down payment, and that gives you your total amount that you actually would owe then on the mortgage. Now, for the mortgage itself, 482,500 that you're going to end up having to take out. Now, the thing is here with an FHA loan, typically you have to pay an upfront MIP as well as an annual MIP. Now, specifically for an upfront MIP is 1.75% the overall mortgage. So that would come out to 5, which if you were to go ahead and do the math on that, Simply put, 482,500, multiply that by 0.0175, 8,433.75. And that's kind of what you're ending up with for your upfront payment, and that must be paid right away upfront. Now, what you can do, though, like I said previously, is you can roll this into the mortgage. For all intents and purposes, to not make things more confusing, we're just going to say that the person decided to pay that. Okay? Because you're rolling the mortgage, it's going to change a few things up. Now, no matter the case, so moving forward here, now comes their annual monthly payment, and we stated before their annual monthly payment will be 0.15% to 0.75% of the mortgage monthly. So that comes down to 0.0015 to 0.0075. Now that there is going to range then between $60.31 to $301.56. That's on average what it's going to range to, doing our broker mathing again. Okay. Now, with that said, that there is an average, and that average ranges because typically the timeline of, could it be a 15-year, could it be a 10-year, could it be a 30-year loan, it all depends. Now, in this example here, we're in most cases on a 30-year loan, though, it's something like this, usually probably looking around probably 150 to 120, so we're going to say 135 is what that's going to be, just off my broker brain, knowing these things quite well. So we'll stick around 135 is what this here will probably come out to be for our MIP that we're going to pay monthly. Now, on typical mortgages right now, when looking on the market, I'm finding the FHAs are usually around the area of like 6.25%. Which, if we do our broker math, and this is very intense, this kind of math, so I'm not going to get into details on it. If you guys want me to in the future, I'm happy to. But at this point, I just want to try to keep it as basic as I can for you guys. But anyways, the 6.25% here that we're talking about, it comes out to $2,970.56. This includes your principal and your interest that's involved in there. Now, we're not going to include the escrows, which would consist of your insurance and your taxes. We're not going to do that, just to keep that out to make things simpler to understand and digest right now. Now, with the principal, interest, and the MIP here, is what we usually got to put together to add them all up, which is taking the $2,970.56 plus the $135, which will give us $3,105.56. Is what you're going to pay monthly. Not too bad. Now, what we're going to do is we're going to take a look at this, though, as I said previously, when comparing it to a conventional mortgage. And how I stated previously that it's not always smart just to look at the interest rate. It's always smart to see as well what you're paying in the end monthly, because that will really tell you if you're actually saving or not at the end. Alright, so let's take a look at this example with the conventional loan. But actually, before I jump into that any deeper, let's take a look at this 6.25% for the FHA loan and the 6.85% for the conventional loan. I do want to state that both these interest rates here are based primarily on having a credit score of a 640 or above. So they're quite high credit scores, just so you guys are well aware of that. No matter the case, though, let's jump into this now. So the conventional loan itself, for this example, it consists of a 20% down payment, which on the $500,000 property, that'd be about $100,000. Okay, the mortgage itself would be at $400,000 then, because that's $100,000 off of the $500, which makes it about $400,000 then. There is no needed for PMI in this example because we have at least a 20% down payment. Okay. And like I said before, the 6.85% interest rate is what we're working with for this particular conventional loan. Now, at 6.85% interest rate, based on using my broker math, which I'm not going to get into the details on that, again, like I was saying previously, that's going to put you at about $2,624.80 monthly for your monthly payment. Now, if you look at that comparable to the $3,105.56, there's a significant difference there. So the $135 and also the $2,970.56 combined together, those there added up to be a lot more expensive, funny be it, than the $2,624.80 monthly, even though the interest rate is lower with the FHA as comparable to the conventional loan, which is at 6.85%. So, interesting. Now, the difference here we're looking at for payment is a $480.76 is what we're looking at for a monthly payment. Now, that's a big difference monthly. If we take that there over pretty much the life of the loan, okay, that equates to $173,000, $73.60. And I can even show this doing it again. So we're taking $480.76 We're multiplying it by 360 months, because that's usually about a 30-year loan, and that's how we end up with that 173, 73, 60. Very, very big savings you'd have if you actually went with the conventional loan in this example than the FHA loan. So there are prime examples here, like this one here, where you can clearly see that FHA loan may not be the best option compared to a conventional loan. It can actually happen out there. So it's always good to see what you're paying in the end and compare it around. And this is what I do as a broker consistently to make sure that those I work with, end up with good price loans and such. No matter the case, though, I hope that you guys are able to see the mechanics on the FHA specifically and kind of how it works. So therefore, through this example, it makes a lot more sense to seeing the benefits of it as well as maybe not the benefits too at some points in time. We, as a broker, I always work to try to find the best loan that fits my client best in their situation. Sometimes it could be an FHA, sometimes it might be a conventional. It all depends on their scenario and all that they have going on. But no matter the case, I hope in the end you guys are able to understand the mechanics of an FHA loan through this example. These loans are often used for primary residence and have limits on the loan amount, which vary by location. Typically, a borrower cannot have more than one FHA loan on primary residence unless they're relocating for work, increasing their family size, divorcing, or if they're a co-borrower that's leaving the loan. Or lastly, actually, if they're a non-occupying co-borrower. These are the only mechanics that could actually impact whether they're able to actually have two FHA loans. Beyond that, though, typically you are not able to have two FHA loans on a primary residence or on having on two separate residences, we'll say. So anyways, this here is a lot of information with regard to the FHA loan and kind of how it functions and works. If you have any questions, please go ahead and write them in the comments down below, and we'll be sure to answer them as quickly as we can. Beyond that, hope you enjoyed the information. Hope it was very helpful. And please do go ahead and like and subscribe if you're liking our content. We'll hope to see you soon again.